Ever wondered what Form 2553 is and why it's crucial for your corporation? Well, allow me to shed some light on it. Form 2553, in essence, is a tax form used by corporations who wish to be taxed as an S corporation. Now you might be wondering, what's an S corporation? An S corporation is a special type of corporation that draws its name from subchapter S of the Internal Revenue Code. This designation allows the corporation's income, deductions, and credits to pass through to shareholders who report these amounts on their individual tax returns. It's a popular choice for many small businesses due to the tax advantages it offers. So, in a nutshell, Form 2553 is a bridge between your corporation and the potential tax benefits of being an S corporation. Now that we've covered what Form 2553 is, let's delve into the process of filing it. Before you jump into filing Form 2553, you need to ensure your corporation meets certain eligibility criteria. Let's dive deeper into what these are. Firstly, your corporation must have no more than 100 shareholders. This is a strict rule set by the IRS and is non-negotiable. Now, who can be a shareholder? Well, all shareholders must be U.S. citizens or residents. This means that foreign investors are not eligible to hold shares in an S corporation. But it's not just individuals who can be shareholders. Certain types of trusts and tax-exempt organizations can also hold shares in your corporation. These include grantor trusts, voting trusts, testamentary trusts, and certain banks and retirement trusts. Moreover, these shareholders must all agree to the S corporation election. This means that everyone has to be on board with this decision. If even one shareholder does not consent, the corporation cannot elect S corporation status. Now let's talk about stock. An S corporation can only have one class of stock. This means that all shares must confer identical rights to distribution and liquidation proceeds. However, voting rights can differ. It's important to note that if your corporation has both voting and non-voting stock, it's still considered as having one class of stock. So, you see, there's a bit more to the eligibility criteria than meets the eye. It's not just about having a certain number of shareholders or being a U.S. citizen. There are specific rules about the types of shareholders, the kind of trusts, and the type of stock that your corporation can have. And remember, these are just the eligibility criteria. There are other considerations like the filing deadline, unanimous consent, and tax implications to think about before electing S corporation status. Once you've established your corporation's eligibility, it's time to consider the filing deadline. Timing is everything when it comes to filing Form 2553. This form, which is a crucial step in electing S corporation status, must be filed within a very specific time frame. Generally, you need to file it no later than 2 months and 15 days after the beginning of the tax year in which the election is to take effect. So if you're planning to kick off the new tax year as an S corporation, you'll need to have your paperwork in order well before then. But what if you're ahead of the game and planning for the future? Well, there's an option for you too. You can file Form 2553 at any time during the tax year preceding the tax year it is to take effect. So if you're ready to make the switch, you can get a jump start on the process. Now that we've covered when to file, let's look at who needs to be involved in the filing process. Filing Form 2553 isn't a solo endeavor. It requires unanimous consent and specific signatures. Now, what does this mean, you might ask? Well, let's dive in. Unanimous consent is a fundamental requirement for electing S corporation status. This simply means that all shareholders must be on board with the decision. No one can be left out, no one can be ignored. Every single shareholder must agree to the S corporation election. This is a crucial step as it ensures that everyone involved in the corporation is on the same page and consents to the changes that come with this election. But unanimous consent isn't just about verbal agreements or nods of approval. It's more concrete than that. It requires signatures, not just a few, but a majority of the shareholders must put pen to paper or fingers to keyboard in this digital age and sign the form. This signature is a formal acknowledgement of their consent to the S corporation election. It's a binding agreement, a commitment that they're ready to embrace the change and all that it entails. Now, if your corporation has multiple classes of stock, things get a little more complex. Each class of stock must also agree to the election. This means that not only do the shareholders need to agree unanimously, but each class of stock must also be in agreement. Again, this is to ensure that all stakeholders are on board with the changes and understand their implications. To sum it up, unanimous consent and specific signature requirements are not hurdles but essential steps in the process of filing Form 2553. They ensure that everyone involved in the corporation is in agreement and ready for the shift to S corporation status. With unanimous consent secured and the form signed, it's time to consider the tax implications. Electing S corporation status isn't just a paperwork exercise, it has significant tax implications. It's like a whole new world of tax possibilities opens up for your corporation. And at the heart of this world is the concept of pass-through taxation. So, what's this all about? Well, in a nutshell, pass-through taxation means that the corporation's income, deductions, and credits pass through to the shareholders. The shareholders then report these on their individual tax returns, and taxes are paid at their individual income tax rates. Sounds simple, right? But it's a game changer. You see, normally corporations are subject to double taxation. They pay tax on their profits, and then shareholders pay tax again on the dividends they receive. But with S corporation status, this double taxation is avoided. The corporation's income is only taxed once at the shareholder level. And here's where it gets interesting. This can be particularly advantageous for certain businesses. Let's say your business is in the early stages and not turning much of a profit. Or maybe it's a family business with shareholders in lower tax brackets. In these cases, pass-through taxation can result in a lower overall tax bill. But it's not all sunshine and rainbows. There are some caveats to consider. For instance, if the S corporation has previously been a regular corporation, or C corporation, and it had earnings and profits, there could be a tax if the S corporation has passive investment income that exceeds 25% of gross receipts for 3 consecutive years. Also, while the corporation itself may not pay income tax, it still has to file a tax return. And it may be liable for other taxes, such as certain state taxes, an excise tax, or the built-in gains tax. While there are benefits to electing S corporation status, it's not a decision to be made lightly. It's like stepping onto a tax roller coaster. It can be a thrilling ride with potential for big savings, but it's not for everyone. So, before you jump on board, make sure you've done your homework and consulted with a tax professional. It's always better to be safe than sorry when it comes to taxes. Once you've elected S corporation status, it's not set in stone, but revocation comes with its own considerations. So let's dive into the nitty-gritty of revocation of S corporation status. Now, once a corporation has elected to be treated as an S corporation, that election remains in effect until it is willingly revoked or involuntarily terminated due to certain circumstances such as failure to meet the eligibility criteria. This is not something you take lightly. You don't just wake up one day and decide, I'm done with this S corporation thing. It requires careful thought and planning. Revoking S corporation status can have a significant impact on a corporation's tax situation. It's not as simple as flipping a switch. The corporation may become subject to corporate income tax, and shareholders may face double taxation. This happens because the corporation's income is taxed at the corporate level, and again at the individual level when dividends are distributed. Quite a pinch, isn't it? Additionally, the timing of revocation can also have tax implications. If revocation occurs in the first 2.5 months of the tax year, it typically takes effect for the entire tax year. If it occurs after this period, it generally takes effect for the following tax year. Timing is everything, you see. Given these potential tax consequences, it's absolutely crucial to consult with a tax professional before making any decisions about revoking S corporation status. They can provide a detailed analysis of the potential tax implications and guide you through the process. This is one of those times when you want to leave it to the experts. In conclusion, revoking S corporation status is a major decision that can have significant tax implications. It's not something to be done on a whim or without professional advice. So take your time, weigh your options, and make an informed decision. And that wraps up our discussion on Form 2553 and the implications of electing S corporation status.